We are just moments away from the Fed's decision on interest rates, and economists are banking on another cut. We saw a quarter-point reduction last month. The central bank is expected to follow suit today. So if that pans out, it would be the Fed's third rate cut in a row. And we just got breaking news that, in fact, they have cut interest rates by a quarter of a percentage point. CBS News business analyst Jill Schlesinger is here with me in Studio 57 to break this down. Our producer, Corey, just telling me that breaking news
Corey,
right in my ear. He's
amazing.
on top of it. So what does this mean?
Well, you know, it's very funny because it was well telegraphed. And what do I mean by that? I mean that Fed officials give speeches all the time. And certainly Fed Chair Jerome Powell has been saying, hey, we kind of want to get these interest rates back to historically normal levels. And we don't really know what that means, like where we end. But what I think this is really telling us is that the Fed is happy enough directionally with the inflation rate. It is heading lower. Yeah, last month it ticked up a little bit.
Right.
But overall, they think that the trend is the right way, right? The trend is your friend. And I think that what this also tells us is that the Fed believes that the economy is strong, but not so strong that reducing rates again will zoom us ahead, create more inflationary pressure.
Okay, but per what you just said, the inflationary report last month, not great. Some recent data shows us that inflation is just being so stubbornly sticky, and a lot of analysts were saying that the current economy didn't warrant another cut.
Yeah, I think that the Fed's in a tough situation because they are looking through the actual data and seeing trends, right? So we know that housing has been a big component of why the inflation rate remains high. And yet, when you look at on-the-ground information, people who are renewing their leases this year saying no change from last year. So some of the data has to catch up. But the other piece of this is really clear, and that is that for borrowers, you're a short-term borrower. You've got a big, fat credit card bill, and you're financing it. Sure, a little cut is great. Any little bit does help. But to be clear, the actual annual interest rate on those credit cards, it's over 20%. It's about 23%. Before the pandemic, it was 14 or 15%. That is just an enormous jump. Now, a lot of people did a great job of paying down their debt during the pandemic, but we are seeing credit card balances start to creep up again. And so I think that's very difficult for people. It may be one of the key issues as people move forward. They need to feel like they can pay their bills, and that credit card balance is a big bill for many.
And so we know you don't have a crystal ball,
Yes,
but given
I do.
what we've heard from the Fed, what tea leaves are they putting out? Is this going to be the last cut for a while?
I don't have a crystal ball, it's true, but I do have a magic 8 ball. And when I asked it, I shook it up and I asked.
It said ask again later?
It said ask me again in a half hour. You know what? I think the Fed makes these projections about the economy, and they're just human beings. You know, they've got all the data that every other economist has. The big surprise in the Federal Reserve's mind is that the economy has been as strong as it has been, that job creation has been good, that we have seen the inflation rate stay stubbornly high, but they still know to get down to a rate that is more historically normal would mean they have to reduce rates again next year, probably by a total of 0.75 percentage point. Okay, so here we are. We end. This is called the terminal rate. Where we end of this rate cut campaign is probably going to be by the middle of next year, and it's not going to be zero. Do you know why? 0% interest rates was an emergency, break the glass. It's a problem scenario. We've had that happen twice in the last 15 years, after the great financial crisis and then during the pandemic. We're not going back to zero, but if we're back at 3.5%, I think that's a level at which we're going to see more people be able to cope with their debt, and also savers will still be able to make a little bit of money on their safe money.
Okay, Della Jill, thank you so much as always.
Thanks.